Hi everyone, welcome to day 9 of Fintech Tour 21. My name is Sagar, I'm part of the Fintech Saudi team. And it's a pleasure to have you all here. Thank you for joining us for this lunchtime session. We're really pleased to welcome Professor Douglas Arna, who's going to be giving us a guest lecture on the importance of regulation technology and supervision technology. Professor Douglas has got a really interesting history, so I'm just going to read out a little bit about what his background is. So Douglas is the Kerry Holdings Professor in Law at the University of Hong Kong and an expert on financial regulation, particularly the intersection between law, finance, and technology. He is the Faculty Director of HKU's LLM in Compliance and Regulation and LLM in Corporate and Financial Law, a member of the Hong Kong Financial Services Development Council, and a Senior Visiting Fellow of Melbourne Law School, University of Melbourne. He has published over 15 books and more than 120 articles, chapters, and reports on international financial law, regulation, and has consulted, among others, the World Bank, Asian Development Bank, and Arab Monetary Fund. He is also one of the co-developers of the edX Introduction to Fintech course by Hong Kong University. And we're really pleased that we've got a long-term relationship with Hong Kong University and Professor Douglas, particularly related to the course. And we're making some interesting announcements coming in the new year on that. So you haven't got a better person than ever to ask any questions you have about RegTech or supervision tech that you have. So please do write any questions you have in the Q&A, and we'll try and get through as many as we can. We do love to hear the questions from you all. Without further ado, I'm going to let Professor Douglas do a short presentation, and then we can go into a bit more of a discussion and have some Q&A. So over to you, Douglas.
Thanks a lot, Sagar, and thanks for the invitation to join Fintech Tour this year. Really excited to be here, and I should say big congratulations to you and the whole Fintech Saudi team. I think you guys are probably getting a little bit tired at this stage. It's been a big project, and I think we're getting close to the end. So congratulations, and thanks again for the invitation to be here. As Sagar said, I'm going to be talking about regulatory and supervisory technology, RegTech and SupTech. And it's interesting, around this time every year, I start thinking about what are the topics that I've been asked to speak about with central bankers and regulators the most in any given year. And if I think of 2021, I think two topics really dominated. The first, very much central bank digital currencies. And almost every week I've spoken about some issue around central bank digital currencies. And the other has been RegTech and SupTech. I think it's been really an aspect that is getting a lot of attention from regulators, central bankers, and policymakers. And I think it's something that we're going to see a lot more of over the next couple of years. So what I'm going to do is I'm going to bring up some slides, and you're welcome to a copy of these slides from the team at Fintech Saudi later on if you wish. So the starting point is really this idea of what is RegTech and SupTech. And what we're seeing is increasingly a pretty broad definition. The idea of using technology for regulatory implementation, compliance, and monitoring by regulators, supervisors, market participants, infrastructure providers, and others. So what you get here is a pretty broad idea that it covers aspects of compliance by industry. Certainly that's your sort of RegTech idea. It likewise includes the use of technology for supervision, for monitoring by supervisors. That's the SupTech idea. But increasingly, we're seeing the design of regulatory systems around digital regulatory reporting, or a variety of systems whereby industry inputs information which can then be reviewed by regulators automatically in some cases. And we're seeing an increasing range of discussions, not only about uses of AI, artificial intelligence, and machine learning by industry for compliance purposes, but also increasingly by regulators and supervisors themselves from the standpoint of monitoring compliance and market function. And I think that really highlights something, that when we're thinking about RegTech, SupTech, we're thinking about any regulated industry. And of course, financial services as one of the world's most regulated, digitized, and globalized industry has been a real leader here. But particularly the past 2 years has seen a major expansion in the use of technology in other regulated industries. We can think of this most directly in the context of health. Think about all of the different sorts of health monitoring systems and apps that we all have to deal with as a result of COVID almost every day. This is RegTech. This is RegTech which we as individuals use to comply with regulatory requirements around health issues, for instance. Likewise, if we think about aspects of travel and the use of a variety of different sorts of technologies, monitoring app systems to monitor travel rules, travel restrictions, this is regulatory technology. It's using technology to comply with and monitor regulatory requirements in the context of travel. The other area where we're really seeing this beginning to grow very rapidly is in the context of transportation, as we think about, in particular, the use of autonomous vehicles or tracking of airliners, for instance. And of course, if we look forward a little bit around data itself, data privacy, data use, data storage, and of course, around ESG requirements and building digital systems for these. So yes, we can think that finance and fintech has been a real driver in RegTech so far. But as we look forward, I think increasingly many in the industry are seeing that some of the biggest drivers are coming from other regulated industries outside of financial services. When we think about this idea of RegTech versus SupTech, often one may think of RegTech as industry complying with regulatory requirements, and SupTech as essentially supervisors using technology to monitor compliance with regulatory requirements. And of course, what that does is it really makes the two sides of the same coin. In other words, industry using technology to comply with regulation. Regulations are set by regulators and supervisors. Regulators and supervisors using technology to monitor and enforce compliance with regulation. Very much, they're two sides of the same thing. And we can see this particularly if we look at something like digital regulatory reporting. In other words, where we have a requirement that information, for instance, stock listing information is disclosed in a digital format. And we can think about companies, listed companies, using technology to collect the information which they have to disclose and to process it into the requisite digital form. And of course, we can then think about supervisors from the standpoint of markets using that digital regulatory reporting to structure and collect information, which they then use for monitoring of compliance with those supervisory requirements, and increasingly also using that data that is being collected via digital regulatory reporting systems from the standpoint of enforcement actions. And so if we think about this, RegTech, SupTech, really two sides of the same coin. And when we think about industry participants, we can talk about RegTechs, and RegTechs, we'll often think of RegTechs as RegTech startups in the same way that we think about FinTechs as being FinTech startups. But if we look at the composition of the industry, the major players are the big tech companies. They are the big information companies. They're the big consulting companies. They're the big exchanges. So one can think about IBM Promontory. One can think about LSE Refinitiv. One can think about NASDAQ. One can think about Amazon. One can think about Moody's, Bloomberg. the big four, and the major consulting firms. These are really your major industry players. And in many cases, they are working both with incumbents. So on one side, working with incumbent financial institutions on using technology to better comply with regulatory requirements, or also with startups. One of the biggest costs for a startup, a fintech startup in particular, is compliance costs. And increasingly, we have a range of providers who are providing solutions to incumbents as well as startups to help them manage those costs and those requirements. But very frequently, they're also working with central banks and regulators on the other side in helping them to design the systems that are collecting information and analyzing the data that are coming in. And I think a useful way to frame this is to think of it as a continuum, this idea of the RegTech Continuum. And essentially at one end, you have the use of technology for compliance purposes by a regulated industry. And of course, at the extreme end, you can think about the use of technology for compliance purposes by startups in a regulated industry. You can also think about those services being provided by startups to participants. As you move along the continuum, you can imagine that actually our biggest portion of the market is actually large providers like Amazon or Bloomberg or NASDAQ providing services to incumbent industry players. And if we think about the volume of money and business concerned, that's really where your scale is. And it's also the case that we're seeing a lot of consolidation. We're seeing a lot of these bigger players buying the smaller startups. And this is something that one sees almost every week, is the acquisition of one of the RegTech startups by one of the major players, as we see a continuing process of competition by acquisition. And then, of course, you can see the supervisors in the middle. The supervisors are using analytics systems to analyze the data that they are collecting from industry as a result of the massive numbers of regulatory reporting requirements that we have all across the world. But increasingly, supervisors are also setting requirements that information must be reported in a certain digital format. That not only reduces costs for industry from the standpoint of compliance, but it also, from the standpoint of supervisors, gives them more structured data sets, which then they can more easily apply their own analytics from the standpoint of monitoring and enforcement. And increasingly, we're seeing a trend towards supervisors, central banks, as well as public-private partnerships actually building infrastructure. And the infrastructure that one may think of could be something like an Edgar system in the United States, where you have reporting requirements, where you have information that has to be submitted digitally. That information has to be submitted into a specific system, which then makes the information usable from the standpoint not only of supervisors for monitoring and enforcement, but also by other market participants. Or one can even think about something like a central bank digital currency, and the fact that a central bank digital currency may well be designed to collect certain forms of information. And as a result, it's not only a piece of payment infrastructure, it's also a form of supervisory infrastructure, in that it collects data on the payments and transactions being made, which can then be fed to supervisors from the standpoint of their various decisions, whether those focus on monetary policy or money laundering, or other forms of tax control or financial regulatory objectives. And so when we talk about this idea of RegTech broadly, it's really a big spectrum, a spectrum going from startups and industry all the way to fundamental financial market infrastructure. And what this is all about regulatory requirements and the way that technology can be used to comply, supervise, enforce, and build those systems. And if we want to think about a sort of taxonomy of that continuum, you can see startups, obviously, incumbents, big techs. It's very interesting if one looks at some of the offerings from some of the big techs. Amazon is a very good example, to see that they are actually increasingly offering an integrated set of compliance tools for financial services participants, but also for participants from a range of other regulated industries, particularly when one thinks about data privacy, data collection, data localization requirements. They're also offering services to supervisors and, of course, individuals. And from a standpoint of why we're seeing this, of course, efficiencies, reducing costs for industry, but also about achieving regulatory objectives more effectively. In other words, using technology from the standpoint of regulators to enhance financial stability, to support market integrity, and if we look forward a bit, to support sustainable development. And I think if we look at some of our big areas, many people would say that RegTech is all about AML. And AML, since particularly 2012, has been one of our biggest areas of RegTech, but certainly not the only one. And in many ways, if we're actually thinking about where RegTech is used most frequently, it's really in the securities context, where an increasing range of exchanges all across the world have requirements that disclosure obligations have to be reported in a certain digital format, which then enables use of that data for monitoring by the supervisors and for enforcement actions. Second, where we've seen some of the biggest growth is in the context of financial stability. After the 2008 global financial crisis, an absolute explosion in macroprudential and microprudential reporting requirements over the past decade. And the end result is that financial institutions have had to build systems which enable them to collect and deliver the necessary data to central banks and financial supervisors. Central banks and financial supervisors have had, given the volume of data, in many cases built their own systems, maybe an in-house cloud, or in some cases actually using an external or hybrid cloud mechanism to actually collect that data and increasingly use it from the standpoint of analytics. Think, for instance, about stress tests and how data that are reported from industry can be manipulated to look at a variety of different scenarios. This is all RegTech, SupTech. Sustainable development and inclusion, lots of efforts around digital ID systems in particular, and looking at these as a fundamental way of solving the identity problem, which is central not only to sustainable development, but also to market integrity aspects. And finally, tech risk. And this particularly, we're seeing growth in the context of both cybersecurity requirements, as well as from the standpoint of data privacy, data protection systems. Now, we'll come a little bit later to looking at where we're going, but I want to sidetrack a little bit for how did we get here? And some of the earliest uses of technology in financial services come from the US experience in the 1980s. I mentioned the US SEC and its development of the Edgar system. Predating this is actually FINRA, the US self-regulatory organization, which has built over a period of decades a system for collecting real-time trading information across its membership. And certainly by 2016, FINRA already claimed that it had real-time trading information across 100% of listed equity securities, of 90% of listed commodities and 70% of listed bonds in the United States. So in recent years, we've seen lots of discussions in the US and the EU about building consolidated tapes, basically systems whereby one aggregates all of the various trading information in listed securities taking place across the different exchanges and listing venues, as well as in off-exchange trading activity. And this, from the standpoint of digitization of securities markets, has been a very, very long trend. If we think about enforcement, actually, since the late 1980s, the SEC's major source of insider trading and market manipulation enforcement actions has been SupTech. It's a simple review of trading activity from the exchanges themselves. Exchanges have data on trading, they have data on accounts and account holders. Given a sort of M&A announcement, the SEC would request 6 months of back data from FINRA, NASDAQ, the NYSE, and look for any unusual trading activity in either of the companies or any of their advisors' accounts. And if they found, for instance, an insider of one of the two companies who had made a large trade a couple of months before the transaction, that triggers an investigation. That is RegTech SupTech. If we look at Hong Kong, Hong Kong is a market where we didn't have this sort of system until quite recently, but over the past 3 years, a major project to build exactly this sort of system. If we look at the EU, the past 5-6 years, a major project to build integrated digital securities reporting systems and to use those not only to underlie disclosure, but also from the standpoint of monitoring and enforcement. And I think if we look ahead, this is one of the most rapidly growing areas for RegTech and SupTech around the world, is in the context of securities disclosure, securities monitoring, and securities enforcement activities by industry, exchanges, and regulators and supervisors. Another example has been in the context of banking. And one can think of the idea in the 1990s of the application of market risk quantification systems, value at risk, VAR, Monte Carlo simulations. And this is the first time we see large financial institutions very actively hiring computer science, astrophysics graduates to design these sorts of systems. And of course, we see a reinforcement of this in the context of the Basel Capital Accord with the market risk amendment in 1995, 1996, which allows banks to use internal modeling to calculate their amounts at risk and to set their capital requirements for regulatory purposes for their trading books. We see this reinforced in the context of Basel II in the lead up to 2008. Now, if we think about the past 10 years, we can really think that finance has largely been driven by the 2008 crisis. It's been driven by regulatory changes, massive regulatory changes in the aftermath of the 2008 crisis, and by the application of a range of new technologies to finance by a range of new entrants. And if we look at that period, we can really see 5 driving areas for use of technology for regulatory and supervisory purposes. The first, all of those post-crisis regulatory changes. And if one looks at a globally systemically important financial institution, one of the 30 designated globally systemically important banks, each of these firms is having to make something like 3,000 to 4,000 reports to multiple regulators across the world every single day. And what this has driven is the necessity of building centralized systems to collect the data necessary for completing these submissions. And we see these sorts of back office tech and compliance centers across the world, in India, in the Philippines, in Malaysia, in Poland, in Utah, amongst others. And essentially what these operations do is collect data from global operations, package it and process it into the necessary forms for delivery to global regulators all across the world. And this has driven a massive amount of compliance spending by the financial services industry. A second area where we've seen big changes is in AML. And in some ways, our big date for AML is not 2008, it's 2012. 2012, we see a series of big enforcement actions against HSBC, Standard Chartered, BNP Paribas for billions of dollars in settlements. And each of these settlements brought with them the requirement for that financial institution to improve its systems, but actually to build centralized customer data collection systems that would enable those firms to produce information about any of their customers anywhere on the world on a T+1 basis. And if you're thinking about a firm like HSBC with tens of millions of customers across dozens of countries, being able to deliver information on a single individual anywhere in the world on a T+1 basis was not something they could do in 2012. And so a massive amount of spending on systems to enable this. And I think it's something that if we look last year at the FinCEN papers, which were, I guess, leaked right at the beginning of this year in January. FinCEN, the US AML regulator, and these are a large stock of suspicious transaction reports, the reports that have to be filed by financial institutions and others when they have a suspicion of a suspicious activity. And prior to 2012, there were on average about 200,000 suspicious transaction reports filed a year with FinCEN in the United States. That's a lot of reports. And if you're thinking paper-based reports, that's a lot of paper for FinCEN to be dealing with. After 2012 and up to 2020, that number jumps to 2 million reports a year. Now, how do you get the financial industry doing this? Well, they've spent lots of money on compliance staff and technology, and they are much more concerned about filing reports, much more sort of risk averse. Now, from the standpoint of the supervisors, what do you do with 2 million suspicious transaction reports? If those are paper-based, they very quickly fill up lots and lots of warehouse space, which is expensive and largely useless. And so we've seen a process of digitization where these are being submitted in digital format, and we're seeing a range of regulators all across the world, including FinCEN, Interpol, as well as the MAS, Monetary Authority of Singapore, all looking at how one could use natural language processing of AI to try to analyze all of this sorts of information. More recently, we're seeing an increasing amount of effort towards centralization in some cases, beneficial ownership databases, for instance, in Singapore, in the United States, in the EU, that provide a single repository for information about beneficial ownership of corporations and the ability for the regulators to use that information and analyze it. That is SupTech. We can also think about what is called BCBS 239. BCBS 239 is the risk data aggregation requirement of the Basel Committee on Banking Supervision in publication 239. And essentially what this says is that any globally systemically important bank has to be able to have essentially on a real-time basis an accurate position or understanding of its aggregate risks on a global basis. And this is something that actually, if you think about when this came out in 2012, the technology was really not there to give a financial institution of this sort of size and scope a real-time view of its aggregate risk position on a global basis, which is kind of scary to think about it. But today, the technology is there. And increasingly, we're seeing regulators and supervisors focusing on requiring financial institutions to put in place the necessary technology. So one can think about MiFID, MiFID II. These are the sort of consolidated tape requirements, digital disclosure requirements in the EU, and more particularly in the context of data requirements. And I think we look at where we were in 2019. I think 2019 provides a very interesting snapshot just before COVID hits. And by the end of 2019, global financial services industry had paid over 300 billion in regulatory fines since 2008, a real incentive to spend on compliance. Financial services globally was spending about $300 billion on IT a year as of the end of 2019. Financial services, since at least the late 1980s, has been one of the top 3 sectors in IT spend. And by the end of 2019, global financial services was spending approximately $300 billion a year on compliance. And if one thinks about what is the RegTech opportunity pre-COVID, it's this idea of combining your compliance spending and your IT spending to reduce your fines. And this was very much the direction that we were seeing pre-COVID. And I think if we look at COVID is really driving things forward. It's something that we've all seen, COVID-driven digitization. We've seen this most expressed in the context of digital payments and the fundamental role that digital payments play, not only in financial inclusion, but in crisis resilience and responding to health and other sorts of emergencies. And so lots of effort globally from the standpoint of building better payment systems, including at the G20 level. In fact, the Saudi-led project on building the G20 roadmap for digital payments to apply technologies. We can think about many of the discussions around central bank digital currencies as an aspect, an evolution of this. We can think about efforts around market integrity and AML. And after all, if you think about something like market integrity and AML, all of these non-face-to-face transactions all across the world have out of necessity driven us to use a variety of different sorts of systems in order to comply with those FATF, customer due diligence and onboarding requirements. And probably one of the most important aspects was a decision in March of 2020 by the FATF that a sovereign digital identification system was as good, if not better, than a sovereign paper-based identification system. And this is fundamentally important because this allows the development, the evolution, rapid evolution of sovereign forms of digital identity as a core solution to market integrity and AML issues. Now, of course, we're now seeing regulators and supervisors not only looking at this from the standpoint of how industry can use technology, but also, as I mentioned, with beneficial ownership and centralized databases and increasing use by supervisors of mechanisms to collect information, which they can then use for their own analytics purposes. RegTech SupTech. I think this has been one of our most rapidly growing areas. And if you think about it, it's really quite obvious. In the same way that everybody else was working from home, central bankers, banking regulators, securities regulators were also all working from home. They've had to deal with one another, their colleagues, on a non-face-to-face basis. They've had to deal with the international organizations like the G20 or IOSCO or the FATF or the Basel Committee via Zoom on a non-face-to-face basis. They've had to deal with the financial services industry on a non-face-to-face basis. And think about something like on-site supervision, on-site supervisory processes where regulators would normally send teams to review compliance by financial industry participants have simply not been possible. And so we've seen a dramatic change in regulatory and supervisory attitudes towards their own use of technology, their own comfort levels with using technology. And increasingly, they are going after this strategically. How can they themselves benefit from technology in better achieving their own regulatory and supervisory functions? And we can see a paper this time last year from the FSB looking at rapid increases, and most recently a paper from the BIS just last week looking at the role of SupTech tools for prudential supervision and their use during the crisis. Now, what do we see if we look around the world? I think the starting point is that we're seeing a number of regulators. The MAS has been an example. The UK regulators, both the FCA as well as the Bank of England and the PRA, all have made RegTech, SupTech central to their own competitiveness strategies. But probably more broadly, we're seeing a real movement of regulators and supervisors around the world to digitize their own systems and processes. In other words, if you're a central bank or a supervisor, you collect a lot of information from markets. How do you store it? Do you have basically Excel spreadsheets on PCs? Quite a lot do. Do you have a paper-based ledger that you stick in a drawer? You might be surprised at pre-2019 just how many central banks would have collected information on a paper-based ledger stuck in a drawer. And increasingly, we're seeing supervisors and central banks thinking about their own digital storage systems. How do they store the information that they have so that they can maximize the benefits of that information and also maintain its security? And once you begin thinking about that, you then begin thinking about how you collect information. In other words, you look at all those forms and you say, why am I collecting a handwritten form? Someone on my staff then has to do a data entry process of typing that. Why don't instead I simply require that information to be submitted in a digital form, which can then come in and be more easily usable from the standpoint of my staff in processing their monitoring and enforcement objectives as part of their regulatory and supervisory mandates. And this is something where, if we look at, in addition to the MAS or the UK, we can see that the EU, in particular ESMA, has really made some major changes. The volumes of essentially information that ESMA now collects as a result of MiFID II regulatory requirements, and the systems that ESMA and other regulators have had to build to collect and use that data is something that we're seeing, as I mentioned, in Hong Kong and a range of other jurisdictions around the world. We're also increasingly seeing this reflected in enforcement actions. In other words, regulators and supervisors actually mandating that regulated financial institutions improve their own technology systems to support compliance. We're seeing clearly this in the context of cybersecurity requirements all across the world. We're seeing this in the context of data protection requirements. But if we look back over 2018, 2019, 2020, we can see a series of cases involving Goldman Sachs, UBS, a range of other global investment banks, and UK and European regulators penalizing them for failing to report, improperly reporting, or reporting when they didn't need to, tens of millions of transactions. Think about that, tens of millions of transactions. The only way you can do tens of millions of listed securities transactions in a 2-year period is high frequency automated trading. But if you've got to report all of those transactions, there's not somebody sitting at the end of the trading desk filling out millions of reports. Rather, you automate the compliance process so that information can be submitted. And essentially, we're seeing requirements from regulators that financial institutions have to integrate their tech systems to enable them to comply with regulatory disclosure requirements. More recently, last year, we can think of October 2020, a big settlement with Citibank in the United States, where Citi had to pay a $400 million fine, their CEO had to go, and they were mandated to build an internal system that would allow them to comply with the US's implementation of those BCBS 239 risk data aggregation requirements. And so, if we think from the standpoint of industry, some of the fastest growing areas are, of course, in the context of cloud over COVID, where you are using cloud not only for operations, but also for compliance and monitoring. And in fact, many of the cloud services providers are increasingly selling compliance and monitoring products to industry participants to better enable them to comply with regulatory requirements. And so, to sort of wrap up, if we think about this idea of use of technology for compliance purposes, for monitoring and enforcement purposes, and building of systems, I think that probably our most rapidly growing area this year and over the next, not only next year, but over the next 5 years, is going to be in the context of digital regulatory reporting requirements. As regulators and supervisors digitize their reporting requirements, as industry then has to use technology to comply with these regulatory requirements, and as both industry and regulators use a range of analytics to analyze the data which are being collected, either to manage risks or to maximize performance, either from the standpoint of regulatory objectives or from the standpoint of profit maximization. And if I think about the dozens of central banks and regulators that I've spoke to across the past year, this is very much one of the most common regulatory and supervisory initiatives that I'm seeing all across the world. So with that, that's a quick tour of a lot that is happening in an area that I think is really exciting, both in terms of what's happening as well as its potential. Back to you, Sagar.
Thank you very much, Douglas. That was really, really useful. That was really inspiring, really insightful, and I really appreciate. We've covered quite a bit in a short space of time, so I'm pleased there will be a recording of this session so people can go back and sort of absorb a bit more of the information. I just wanted to cover some of the questions, if I may, just which we've been getting on the chat and in the Q&A. Just one question to start off with. So there seems to be a cycle here where we over time we're requiring more regulations are required, more reports to be generated, and it's getting to the point where you said there's 2,000 reports sort of being generated, or even was it 3,000 to 4,000 reports being generated by financial institutions a day. And that volume has led to the need to use technology to digitize a lot of that so that the information can be absorbed. Do you think, based on, I guess, the history of regulation, is this a trend which is just going to keep increasing? Are we just going to see more and more regulatory requirements from regulators, which will then require more use of technology to be able to comply with those regulations?
Yeah, I think a very good question. And it is something that there's been, if you look at history of financial crises and regulation, there is this idea of a regulatory pendulum that you get a crisis. In the aftermath of a crisis, you have a big regulatory response, new regulations, all designed to try to prevent that crisis from happening. Over the next 10 years, you see a gradual sort of relaxation of regulatory requirements. You see new innovations, you see new sorts of market enthusiasm, and you get another crisis. And then it starts again. And I think we've very much seen that. It's going to be interesting to see how things play out over the next year, because you think about 2008, in the immediate aftermath of 2008, you see this huge increase in regulation. And this is one thing that actually drove the whole Fintech trend, is this new regulation, the costs, the leaving of different sorts of activities. And of course, all of these discussions about how to regulate innovation. Now, over the past 5 years, you've seen regulators becoming more and more focused on supporting innovation, on supporting development. Then you get the unusual thing of, instead of a financial crisis, you get COVID happens. And the good news of COVID has been that we haven't had a financial crisis. In other words, if you think about March 2020, the markets held up to all of that volatility. And perhaps it's some of those post-2008 regulations that helped with that. We're seeing questions about how to make things better, but I think we are in this cycle where things are actually relaxing at the moment compared to where they were a few years ago. The end result is eventually, sometime in the next 5 years, we'll see another sort of financial crisis of some sort, and then the cycle starts all again. So I think the bad news in some ways is we're probably at the more liberal end of the spectrum right now, as opposed to the more restrictive end of the spectrum.
And any thoughts on what that crisis could be? The former governor from Sama said the biggest challenge for the banking industry going forward will be cybersecurity, will be cybersecurity attacks and challenges. Have you got a view on where you think that next crisis, that financial crisis, could be?
Yeah, you know, it's something that some days I get to put on my optimist hat and think about how everything could be better. And some days I have to put on the other hat and think about how it could all go really terribly wrong. And yes, cyber is one of those areas where the potential for a catastrophic outcome has increased dramatically with digitization. You know, it's interesting. I saw a statistic recently that since 2020, the numbers of cyber attacks on financial services firms have increased by 400%. And this is, of course, if you think about most rapidly growing area of crime is digital crime, but also we're dealing with hacktivists, terrorists, state-to-state aspects. And the end result is that if one thinks about some of your worst possible scenarios, they definitely involve cyber. I think other aspects where we can look at, you know, one could think about, it's interesting, if we think about digital assets, for instance, over the past 10 years, supervisors almost every year have come to the conclusion that there are all kinds of consumer protection risks, but generally markets weren't big enough to pose systemic risks. But increasingly, I think regulators and central banks are having real questions about potential systemic risks coming out of digital assets. And so that's an area where I don't think that's necessarily the source of your next 2008 crisis, but one could definitely see as we see the expansion into ever new products and markets, that's an area of potential vulnerability. One can definitely say that we're likely to have more sustainability crises. So one can think about pandemics, epidemics, one can think about climate change, one can think about refugees. These are all the sorts of areas where definitely we're seeing more and more crises with more and more implications for financial services. In some countries, if you are the Maldives and you're faced with your country ceasing to exist in the next couple of decades as a result of sea level rise, that's a catastrophic outcome. In others, it's going to be different, but one of the biggest risks is in the context of insurance or banking markets. And so I think we can look at a variety of potential sources. The bad news is it's almost never the ones that we anticipate.
Yeah, that's a very point. Just going back to one of the points you made about digital assets, I guess digital assets being borderless, cross-border, being able to sort of anyone being able to trade internationally in any market. Do you think that there's a need for greater, I guess, cooperation between different regulators in different markets? Because regulators essentially are concerned about what happens within their borders. But if more and more activity is borderless, does that require the need to change that thinking and maybe change the infrastructure of how that works?
Yeah, I think there's no real question about this, that unless you want to take an approach whereby essentially you control internet traffic in and out of a jurisdiction, that's almost the only way to actually effectively monitor transactions in digital assets on a cross-border basis. So that's one route that you can do. You can close your internet and that gives you a route. But I think for most countries, that's not going to be really seen as a desirable approach. And therefore, if we really are talking about global markets, I think it really is essential for regulators to work together. And it's interesting because we've seen this in the context of global stablecoin efforts. This was sort of driven by the original Facebook Libra proposal, now Meta and Diem. We've also seen it in the context of finance more recently, where regulators are trying to figure out basically if you have a firm that is trying to avoid being in any jurisdiction, how do you actually force them to be in some jurisdiction so that then they are potentially subject to someone's regulatory systems? And I think if we look at, for instance, the FATF's VASP requirements, the virtual asset service providers, it makes a lot of sense, but the real question many regulators and supervisors are having is essentially you have to trust the regulatory and supervisory system of everybody else. And as a result, there is an increasing view that what you need is some sort of infrastructure that brings it all together. And I guess one of the areas of RegTech and SupTech where we're seeing some very rapid developments is in the context of the blockchain, whereby the fact that information is generally recorded gives you mechanisms of collecting information, of monitoring transactions that actually potentially makes the markets more secure and more transparent. But we're not quite there yet.
Hopefully get there eventually. In fact, this brings us nicely onto a question from Manira here, is what are the current challenges and gaps towards driving more RegTech and SupTech in the marketplace? Are there fundamental changes in talent or infrastructure? What needs to change to be able to move that forward?
Yeah, it's interesting. I think the single most important or the most effective tool that policymakers and supervisors have to drive RegTech is really setting digital regulatory reporting requirements. If you set that reporting has to be done in a digital fashion, then industry participants will respond to that. You will then have RegTech providers responding and in providing the services and the support. The challenge, particularly in a lot of developing countries, is actually that a significant portion of your financial services industry may not be digitized. And that is problematic because, as I mentioned, in the COVID context, we're seeing this huge value in digital financial services, particularly in digital payments. So actually, there's an increasing focus on trying to make non-digitized portions of the financial sector digitized, so that one, they do a better job from the standpoint of supporting financial inclusion, broader sustainable development, but also because they're easier to monitor from the standpoint of regulatory compliance. So yeah, I think the big one is around this decision around digital reporting. Then your second biggest challenge is around the non-digitized portions of your economy and bringing those into the digital environment. And then I think that really takes us to something that's a little bit beyond RegTech and SupTech, and that is the consumer aspect, which is your sort of digital literacy and financial literacy. In other words, that as we bring consumers more and more into the digital environment and digital financial services, there are tremendous benefits, but we're also exposing them to all sorts of new risks that they don't necessarily understand. And so we really need to think about how can we use the process to increase consumer digital literacy and consumer financial literacy.
That's a very, very, very good point. Unfortunately, we're coming up to the end of time now. One last question which I had is just in terms of if we've got a lot of people here who are entrepreneurs who want to think about developing ideas in this area, what suggestions would you give for them, for somebody sitting there who's saying, I like the area of RegTech, I would like to learn more, maybe even think about developing a solution there, particularly where you said that there's a large number of large organizations, large groups which are looking in this area. Where can the sort of the startups really make a difference in the marketplace?
Yeah, I think from the standpoint of startups, look for the pain points. Look for where startups or incumbents are running into challenges, hurdles, costs, etc. Build a solution and then offer it from the standpoint of they have a problem, particularly the incumbents have budgets. And that's something that is different from the fintech startup context. If you're dealing with incumbents, they have budgets. Find a problem and basically target the solution. If you're targeting startups, realize that for startups, compliance is one of their biggest costs, and how can you give them systems that will enable them to manage or deal with those requirements? And I think the big bit is to think beyond financial services. Think about health, think about travel, think about energy, think about data, and all of these regulated industries and the pain points that exist and how one can build technologies, build solutions that will help.
Thank you very much, Douglas. On that note, thank you very much for your time. It's been a really insightful presentation. The audience has stayed throughout the whole, so you can clearly see that there was a lot of interest in the topic, and we look forward to further collaboration with you in the future. Thank you everyone who's joined online for your lunchtime session. We really appreciate your time and for spending time with us here. We do have another couple of good sessions today. We've got one on digital banking in the afternoon, and then we've got a session with SAMA and CMA, which will actually follow on really nicely from this session, and they'll be discussing a lot of what they're doing around licenses for fintechs and the sandboxes and the fintech lab. So that's a really good session to join us for this evening as well. Other than that, I'd like to thank everyone again for this lunchtime session. Douglas has shared his details there, so I guess if there is any questions or anybody wants to connect with Douglas, you're more than welcome to do that as well.
Thanks, Sagar, and thanks everyone for joining. And hopefully, I'll get to see you in Saudi sometime in the next year or so.
Look forward to it. Thank you very much. Take care.